Hello everyone, it was great to meet you all on Saturday. However, we could not finish the problem number 41, last three entries, due to our time constraint. So what I did, I made this small video where I solved the last three entries and I gave my explanations. Please watch it carefully, and if you have any question about this problem or any other journal entry or any material related to not-for-profit accounting, please email me. I'll be happy to help you. So last Saturday we went over this problem and we completed up to entry number G. So now I will go over the rest three entries. Number H, they consume the medical supplies acquired in C. So they actually bought some medicines. If you look back at entry C, now they consumed it. So it's a kind of a supply expense and they spend all those medical inventory. And if you look at the price, it was 25,000 that they spent to buy those medicine inventory. So this entry will be very straightforward. So it will be here medical supplies expense, or you could also write it down supply expense 25,000, and you also need to reduce the medical supplies or medicine inventories because they already use those medicine inventory, so you have to credit it. Now here, the next entry, if you look at here, the next entry is talking about the investment, and it's actually a bit complicated and long entry, so I would suggest read it carefully, and if you see it's complicated, of course break it into different parts and then you definitely will find it useful. So if you the next entry, it says sold investments acquired in A for $172,000. So let's go back to number A. A mentioned that they actually transferred some money and kept it as an investment to buy an equipment. And that time the amount was 160,000. Now they sold those investments and they sold it for 172,000. Then what they did, they spent all those money, the sale proceeds 172,000, plus they earned some interest, which you already know from entry F that they received some interest from those investment, which is $15,000, plus they added another 25,000 which they kept aside for these equipment purposes. And then they spent all these three resources and bought that equipment. So now what you need to do, you actually need to do three entries. First, let's do the entry to record the sale of the investment. So the investment amount was originally 160. Now they sold it for 170. So they are making a gain on these sales. So the journal entry, if you would like to record the sale, will be here cash debit because they sold it for 172,000. So they received cash. Cash increased. You have to remove the investment because that investment is now gone. You sold it, so you have to credit investment. And remember when you did part A and there was an internal restrictions, so we kind of labeled it as internally restricted. So it would be good to label it again so that you know you are selling that specific investment, which was an internal restricted investment. So it was labeled as internally restricted, and the amount, remember that time the investment amount was 160 that we are now removing, and after selling it for 172 we made a gain. So always gain is a credit, so we are crediting it, gain on sale of investment. So you know the difference, 170 minus 160. So their gain on this investment is $12,000. So this is how they collected the sales proceed after selling the investment. Then what happened? They actually bought the equipment, and I just gave you the explanation. They used three sources to buy the equipment. One is this cash, 172. Another is they earned some interest from this investment, which is in part F, 15,000, plus they also spent $25,000. So now we definitely will include all three amount, but what about this 25,000? This 25,000 was previously given to them, and that time it was of course restricted, and the restriction was that you have to use it for this new equipment. So what you need to do, currently it is now under temporarily restricted net assets. So we have to reclassify it. We have to move it from temporarily restricted to unrestricted before spending it. So before recording the equipment purchase entry, you have to do the reclassify entry. That means I will take it out from temporarily restricted. So our temporarily restricted net assets will be reduced. I'm gonna debit it. And at the same time, unrestricted net asset is increasing by 25,000. So I will credit it. That will be your reclassification entry. So let's do the reclassification entry. So I will remove it from temporarily restricted, temporarily restricted net assets, and the amount is 25,000. Now I am moving it from temporarily to unrestricted. So it is increasing my unrestricted net assets. Remember, before spending any money, make sure it is in your unrestricted net assets. You could not use any money from any restricted net assets. So now I transferred that 25,000 from temporarily restricted to unrestricted. Now I can use it, I can spend it to buy the equipment. Now the rest of the entry is simple. You have to record the equipment purchase entry. So I bought the equipment, I'll debit equipment, and I paid cash for it. And don't forget what's the total amount of cash that you spent to purchase the equipment. Of course, the proceeds from selling the investment, which is 172, plus I'm also spending the money I received from the interest, plus the $25,000 which I already had on the purpose of buying this equipment. So now you add all these three, 172 plus 15 plus 25, which is 12,000. So this is the total purchase price or you spend for the equipment. So I recorded my equipment purchase entries. So here again you see you have to do three entries, and if you do it step by step, then it will be good for you. Now the last entry. So again, last entry, you may need to think of it and break it down. The last entry is they receive pledge for 126,000. It's an unrestricted donation. And then 10% are collected immediately. With 90%, they will receive in future years. Now, they also estimate that 9,000 of this money will never be collected. And the 90% of it that they will collect in future, of course, we assume it will take more than a year. We have to take the present value, and the present value of this money is $98,000. So now here, think of it. One is pledge, and we discussed is pledge. You have to record it when the promise is conveyed. So the entire amount you have to record it now. So the total pledge is 126, and out of that 10% you are receiving immediately. So that means 12,600 cash, you already received it. So we will record it. And of course, it's our contribution. We received it on a spot and there is no restriction. So first I'm going to record this cash received and I will debit cash, which is 10% of my total pledge, which is 12,600. And then this is the contribution revenue I received, and there is no restrictions, so I'll also level it. Contributions, and we will always level depending on if there is any restriction from the donor or not. So we will label it as unrestricted net assets. Now, here, remember, they said that 10% you received on the spot. We recorded it. Another 90% you will receive in future years. Now, here, remember, what's the rest of this 90%? Will you be able to receive the entire amount? They actually said no. You estimate that 9,000 of that amount you could never receive it. So what we're gonna do? We have to reduce that amount and we have to keep those as an allowance for uncollectible pledges. So now here what we will be doing, we will record it of course as a pledge receivables, but at the same time that 9,000 we'll never be able to collect, we will credit it as allowance for uncollectible pledges. Now, remember here, should we take 90% of this entire amount, which is 126,000? No, because we are not able to collect it this year. It may take several years. So we will record it as per the present value. And the problem already mentioned that the present value is 98,000. So based on the present value, which we're gonna collect in future, currently our pledge receivable should be recorded as per 98,000. So of course we will record pledge as soon as we receive the promise, but we will record it as a receivable. So I'm gonna record or debit it as pledge receivables. Of course I have to record it as per the present value, which is $98,000. And at the same time, I know that we'll not be able to collect $9,000. So I will show those under the allowance for uncollectible amount. So I will credit those as allowance for uncollectible. Actually, I will just write it down, allowance for uncollectible pledge. So it will make it more precise. And this amount is $9,000. That means right now our pledge receivable is 98,000, but we couldn't collect 9,000. So the rest, 89,000, we will collect it. So now this you could also show as contribution, but you have to categorize as a temporarily restricted net asset. Although apparently it seems, reading from the first line, that there is no restrictions from those pledges, but we are not able to collect it this year, so we'll collect it in future years, and that's why the rule is that you have to show it or put it under temporarily restricted category. So we will record contributions, but we will show it under the temporarily restricted net assets, and the amount is the rest of these present value of future pledge receivables, so 89,000. So these three little entries, especially last two, those are a little bit complicated, and I'm sorry that we didn't get time to go over it during Saturday sessions, but I hope you will follow this short video and make sure you will understand all journal entries very nicely. Again, if you have any question, you can email me. Thank you.